All right, I'm gonna make sure this is working, and then sorry, let me just double check. All right, perfect. So, thanks for tuning in this week. We got a bit more to unpack. Um, we got a bit of stuff to unpack this week. You'll notice this week I just called it Bitcoin, gold, and AI. I got a few things I wanted to I thought it'd be interesting to talk about. But before we begin, you probably noticed we're starting at 6 o'clock this week. I wanted to move it earlier. I know I'm kind of playing around, experimenting. Um, see, like maybe it's easier. Maybe I figure on a Thursday night, 7:30 at night, who's probably gonna go watch the live stream. So I'm trying to. I wanted to play around with it to see if maybe more people would tune in earlier. You have suggestions on days. If you're watching this and you have a suggestion on better timing or day that you think is would be better, like let me know. I'd be open to switching it up. Um, but yeah, I had a few things I want to talk about, and primarily I thought it would be cool to talk to kind of mention. Um, well, there's a few things. We're going to talk about gold, recent trends in gold and Bitcoin. A lot of discussions I've been seeing on social media. Those of you that follow me, if you're watching this and you follow me on LinkedIn, you probably see I've been pretty active on those debates with people, and I'm going to kind of talk about. I'm going to give my perspective on this. I know I'm Gen Z. As a Gen Z, I know it's Gen Z's perspective on gold and Bitcoin and AI bubble. We keep hearing a lot of the commentary I see comes from older people that are veterans of the industry, and there's nothing wrong. These people have experience. They've seen ups and downs, like the 80. They've seen the 70s, the 80s, the 90s. They know how they have a perspective that's unique and not to discredit, but Bitcoin and stable coins and AI is relatively new. So I think it's always kind of interesting. I think it's interesting that, people forget that it's the generation that creates this new movement, not that who's pushing for this new movement that's kind of going against the grain with traditional finance. Or, it's kind of being it's not given. I don't think it's given as much attention as it deserves. And so we'll talk about that. I also want to talk. I came across an interesting chart. You've probably seen it before, but the Brenner cycle, I believe, I believe it's called the Brenner cycle. I'll put the chart up and we'll talk about it. It's a strikingly accurate, shockingly accurate prediction. I think the one recession that it got 2 months off. It was 2 months off prediction, and this was created in 1875. Like, to put it in perspective, in the U.S., to put it in perspective, that the American Civil War was in the 1860s. This is in 1870s. This is like 10, 15 years after the American Civil War. This guy comes up with prediction that basically predicts all the major recessions. And what's crazy is there's two more recessions that haven't happened yet that he predicts. So we're going to look into that. We're going to kind of discuss, maybe talk a little bit about it. And yeah, so before we dive in, I hope you enjoy this content. If you have any questions or comments, don't forget to you can send an email. The email is in the description of my channel. You can also commodityrow@gmail.com. You can also always just leave a comment below. Always like the feedback. The other thing too is don't forget to like, subscribe. The YouTube algorithm is finicky. If you anything you can do to help I'd be grateful. So yeah, before let's dive right in. Let me just pull up. Right. So sorry, I'm just gonna pull up the. I'm gonna pull up my. So first things first is I'm gonna share my screen. Here we go. Sorry, it's a bit hectic on my screen. Here we go. And I have this. Of course, I have this. You guys probably recognize this. And I'll go to this in a moment. For those of you that that are watching this video, you're looking at is actually the precursor of a larger system, of a larger terminal that I'm building. Um, with several windows, and it's essentially it's designed to basically help traders and investors who want both fundamental and quantitative integration of their data and integration of like analysis. So basically, it's a terminal that's going to aggregate um, qualitative information and then as well aggregate quantitative information and come up with the or quantitative data and develop 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 an analysis. It's I was just playing around with this. I was looking at Amazon earlier. Um, this is like the very primitive version of it. It's essentially right now all you're looking at is there's a technical analysis window part of the terminal. Then there's a CFTC analysis, commitment of trader analysis window. Um, a lot more to come. There'll be an AI. There'll be an AI window. There's going to be an ETF window, which you can look at different performance of indices and ETFs. There's going to be a whole bunch of windows, and I will be releasing more information as they come. But but I'm actually looking for beta testers. So when this releases, you can pre-sign up for to become a beta tester. Um, there's going to be a limited pool of people. So leave a comment below if you're interested in beta testing this when it comes out, and I will be making an announcement. And actually, maybe I'll do a tutorial on my terminal when the beta test comes out, so you guys can kind of follow along and learn how to use it. It's designed to be user friendly, but I want to bring this up because gold, GC equals F. Let's go gold futures and let's go to max low chart. Oh, did not work. Sorry, GC, not FC. GC equals F. Sorry. There you go. That's work. Sorry, I typed SC. Got nervous. Um, and let's take off all the analysis. Actually, let's add back volume. That's loading. It's very slow. I built this in Python. It will actually eventually be built up in. I'm planning on to either develop it in C or Rust. I haven't decided yet, but it will be eventually. It'll be essentially. Um, so it's very. So bear with me if it's slow, but basically what you're looking at is there's been a large and actually I don't have this yet, but cross commodity or cross asset analysis. I'm going to add probably another window into this, but um I want to look at price of gold, but then I kind of want to look at here, let me open up another. Hold on a moment. um sorry. um chart. Here we go. I don't know if you just saw that, but it's essentially or maybe you can't see it. It's essentially you can open up multiple windows. I've developed it. The terminal you can open up multiple windows of the same thing, so you can look at multiple. But I want to get cross asset, and I know I keep emphasizing that. Let's look at BTC equals or sorry not equals dash USD, and let's look at max. Actually, you know what? I'm gonna go back. I'm gonna only do 5 years for those two, and I'm gonna do volume, and I'm gonna go here. 5 years, load. I don't know why that's charting. I have to fix that. So otherwise, never mind. But the point is, so one of the reason the reason I want to look at both of these is because one of the big things that I keep seeing online is there's a lot of people talking about how um, gold and Bitcoin are not correlated. And I would caution something. I would caution and I would kind of bring in an argument. And this is more of an opinion. And again I'm just kind of walking. I want to walk you through my logic. But Gold traditionally is a hedge against inflation. In poor economic times, people will put their money in people the historical perception of gold is that it's a hedge against inflation. There's like the age-old expression, um, like when there's poor economic turmoil, when there's poor economic times, political turmoil, geopolitical instability, wars, commodities do really well. And it's a sinister way of looking at it because it's the truth. Because for example, take the Ukraine war for example. 40% of EU grain imports on average come from Ukraine. So what happens when the Black Sea and is pretty much shut down because of the war for trade, or it becomes more risky to operate in the Black Sea. Then what happens for trade for shipping routes, and then what happens? It creates more of a bottleneck. But then uh, the farmers in Ukraine are all at war, so there's no one farming. So then they lose their crop yields, and then that's when grain prices go up because of the supply and demand imbalance and availability. That's basic mechanics of microeconomic mechanics to look at that. But so I mean, a lot of this volatility, you can just see, and more recently, like going back to 2020, starting in 2023 or 2024, even I remember gold was just soaring, and it's only gotten and again, just look at what we've had 2020, and I mean, even before 2021, like around 2020, we saw gold kind of shoot up slightly, and that was kind of, and then you saw it started to really pick up when you saw Ukraine. After, so you have Afghanistan, then you had Ukraine roughly, and I think it was like Afghanistan and Ukraine, and then you had and then and then after you had the war like the war in the Middle East, you had the Houthis, and then of course the ongoing tensions in the Strait of Taiwan. So that's just kind of compounding into this into this giant, this massive geopolitical risk in premium. I remember when the Houthi rebels were attacking ships. Um, it was like on average there was an extra premium of about $1 million premium per on insurance on these shipping costs. That's just going to shoot up the cost of shipping. So that's again that's geopolitical. That's the geopolitical risk playing out and actually increasing the price. So that's a perceived risk. So then again, poor economic times. Um, so gold soars. And now that's all fun. But then Bitcoin's kind of weird. Bitcoin, and I see what people say. This is 5 years, and this is 5 years. So when you look at the two of them, you can kind of see that, like, yeah, it's not really. You know what I mean? Like, it's not really. Or no, sorry, this is 5 years. This is only 1 year. Let me. Why is it only? Oh, it's not working. Anyways, I don't know why it's. Let me go on this chart. That chart's not working for some reason. BTC. Gosh. I usually have my own keyboard. You can see I'm not in my office, my regular office. So you see, so you see here, there's been an overall, like, there's been a lot more volatility, but then overall, it's kind of gone up. And crypto is very cyclical. I mean, it's basically volatility on steroids is how I describe it. Just look at the just look at red is volume in terms of selling, and then green is volume in terms of buying. Just look at the amount of red down there, and the spikes, and that just when you see a lot of spikes in the volume, that just means there's a lot there's like outlier like massive amounts of shorts and short and long positions going on in the market, in terms of volume. That's kind of that's I mean, from a risk count, that's very alarming. And one of the critiques I saw this morning actually on LinkedIn, I saw someone make a comment how Bitcoin's a scam, and I want to unpack that because I'm getting why because, and I'm going to tie it back. It'll make sense where I'm going with this, but the biggest argument I see for crypto is that there's no valuation. There's no valuation behind it. But when you think about Bitcoin, when you think about any commodity, it's like, and again, I'm going back to gold. When you go back to gold, when I was at the PDAC, Prospector Developer Association in Canada, conference last year, I remember I had a conversation with a guy, and I asked him, what's the value of gold before it's mined and processed? and he told me in the ground, an ounce of gold is about $7, $8. At the time, it's probably higher, probably 12, 13, probably 12, $13 plus now. But at the time, he had told me it was about $7, $8 in the ground. What makes gold shoot up to two, $3,000 is the processing, the handling, the shipping, the whole supply chain process of getting gold from those little bits you find in the ground to like a bullion coin you would buy at the bank or a pawn shop or whatever. That's the supply chain. That's gonna pump up the price because it's gotta go through certain hands. There's labor. There's other factors involved in it. And Bitcoin is different, but it's the same. It's Bitcoin mining is extremely energy intensive, and I want to pull up. I don't have it on my computer. I have it on my phone, so I'll just read the numbers, and maybe I'll post it in the comment section. Actually, I because someone posted it. It's their photo, so I don't know if I can necessarily share it without. I don't know if I can necessarily share it, but let me go to with my images. But this is someone's opinion. But someone had said like if you were to look at like in terms of percentage, what drives the price of Bitcoin in either direction? And this person's analysis, Graham Cook, you can look him up. He made a chart that said 20% of energy cost and 20% of energy cost. Sorry, 20% of the price of the pricing action is attributed to energy. 30% of pricing is involved with inflation. 50% is with tech. And let's look into the I mean, energy is pretty self-explanatory. Again, like I said, it's a very energy intensive. You need a lot of energy and you need a lot of cooling. You're running computers 24/7 to essentially crack these math problems that are or crack the algorithm that's gonna mine you the Bitcoin. But the amount of energy and electricity you need to run the machines and run the computers plus and the GPUs, plus on top of that, you need electricity to keep cool and to keep it at a certain temperature so they don't overheat. Then you have inflation, and I'll go back to that because that's why I think it ties into gold. But then you have 50% of its pricing is attributable to the tech sector, and I mean that makes sense. Tech sector, Web3 technology, blockchain technology is growing. I think that number is only going to go up. I think the percentage of pricing is that high, and it's probably going to go higher in the near term. Is because maybe not in the long term. In the long term, it might level out more even and distributed, but in the near term, you're seeing such a heavy concentration correlated with the tech sector when it comes to pricing of Bitcoin is because Web3 technology and the integration of blockchain in the tech sector. So growing AI, blockchain, Web3 tech is becoming more and more common in the tech sector, and where this becomes kind of this it becomes kind of that's where you get a lot of volatility. Even the broader market, like 40% of I think I saw somewhere 40% of S&P returns are attributable um to the tech sector. So it makes sense. So then where do people so then when people say, oh, the broader market, Bitcoin's correlated when the S&P goes up, Bitcoin's also going up, it's great. I don't think what people have to understand is it's because the concentration of how much of Bitcoin, how much of an influence the tech sector has on the price of Bitcoin because of the applications or sorry, cryptocurrencies in general because of the applications. But then on top of that, 40% of the tech sector's return sorry, 40% of the S&P returns come from the tech sector over the past decade. So that's, I think, where the correlation is. That's where the correlation is. The and so yeah, that's kind of my rant on that. Now, this kind of brings me to another discussion, which is what do you call it? Which is like so I came across and there was another post on LinkedIn that I'd come across, and they'd mentioned essentially that there's a they're basically they were talking about how there's wait, sorry, no, let me go back to my screen, OBS Studio. So this person was talking about or was wrote a whole long post, and let me pull it up. Let's see, I commented on it, but they basically said that Bitcoin's valuation and nothing, and this goes back to the valuation of Bitcoin. He's coming from the perspective that Bitcoin has no intrinsic value. It had, and if you want to look at it, you can't. And this is the flaw, I think, in this way of looking at it. You can't look at crypto as as a stock. It is a commodity. The SEC reclassified it as a commodity. It has the characteristics of a commodity. It's high. It's volatile. It's volatile. It has a scarce amount, and it's heavily influenced by macro factors, and it's cyclical. And there's other reasons why you might call it, but if I was to summarize why I think it's commodity, I agree that's commodity. Those are my 5 reasons. And when you start looking at the arguments for against crypto, is they say there's no intrinsic cash flow, there's no fundamental value, there's no tangible asset. But my argument to them that is, what is fiat? Fiat being the paper money that you and I use to pay for our groceries, to pay for our gas, and to just swipe our credit card at the store. There's nothing to stop the central bank, or the Federal Reserve, or the Bank of Canada, or whatever, from printing the money and devaluing your currency. It's the same reason why, there's an expression I heard my professor once make in my undergrad. Said, if you were to leave your money in your checking account, you may as well light a $20 bill on fire every year, because of inflation, because of fees. It's eroding your money. And that's because of inflation. And why is inflation? Because they're printing money, and so the money is becoming devalued. And where I think where I think it's an unfair comparison, where I think it's I mean, I made the comparison, but I think it's an unfair comparison to look at it the same way you would look at other assets, is because it's not like an equity. So you're not gonna. It's not like you're looking at a company that's producing cash flow. It's A, but B, you can't even compare it to the fiat in the sense. You can't even compare it to fiat truly, in the sense that there's a finite supply of crypto. Of Bitcoin, not all crypto. Bitcoin specifically, there's a finite supply of Bitcoin. 21 million coin. I think it's 21 billion coins, or I have to double check the number. What is total? How many Bitcoin? So 21 million Bitcoins. That's it. That's all there were. Um, and 95% of them are mined already, which is, I think, where we're starting to see things happen. This is why. But bear with me. Fiat has an unlimited supply. You can keep printing and printing and printing, devaluing. So this creates almost like a cruel cycle. I mean, you print, spend, and then inflate. Print, spend, and inflate, or print, inflate, and then spend. Should be actually the order. So anyways, my reply after this guy was going off on, my reply to this guy on LinkedIn was, because he made a comment about, he had made the comment that crypto is not no cash flow. So I posed a question, and I didn't really get a response, but maybe if someone's listening and they have a response, they can write their opinion in the comment section. But my question to people who think like that, or the people who make that argument, is, pre 1971, before President Nixon in the U.S. in the 70s moved after Bretton Woods, moved off the gold standard. So the U.S. dollar, which is the global reserve currency, was backed by gold. So it was backed by tangible assets. So back then, you could say, okay, fiat had a value. It was backed by a tangible asset like gold, which is completely reliable. Gold, by the way, I'll go to that after about gold. Gold doesn't have a cash flow, doesn't have profit margins. So you're going to make the same argument about gold. I mean, that's the other unbalanced perspective there. But then when you look at stable coins. So stable coins are cryptocurrencies. It could be Bitcoin or Ethereum, backed by a tangible asset. So For example, QCAD is the very recently the stable coin. Here, let me find it. Let me pull it up. Here's 1.03. There you go. So the point is, so that's an example of it. But where it gets interesting on in this whole thing is if so again, it's bad. It's a to give that QCAD is an example. That's it's a stable coin, Ethereum based stable coin. I believe it's Ethereum based. Um, oh, what? Ethereum, Algorand, Stellar, Solana, and Base. Basically, it's a stable coin backed by basically it's taking cryptocurrency, backing it again by backing it by and it's backed by uh, by a tangible asset. So, or sorry, backed by a fiat. Sorry, backed by a fiat. So it's a bit of an. I mean, it's a bit of a nuance, but it's a bit of a nuanced thing. You know, you can look at it as you will. You can say, okay, it's crypto backed by fiat, so maybe it's a double whammy on that. But you're almost taking something that has that behaves almost like a commodity, and you're pricing it almost looks like fiat. Sorry, I guess the better way to look at it is it's fiat priced in cryptocurrency. So or cryptocurrency priced in fiat. Sorry, you can look at. I mean, I'm thinking about it in terms of when you look at currency denominations, you can flip them. The, Nonetheless, the point is, yeah, I mean, that was my argument. My whole argument was essentially, sorry, I'm lost my train of thought. The whole argument was essentially that if you're going to make the argument about nothing, and then it has to be backed by something, we haven't seen that even with our own current system since the 70s. So I mean, I think it's kind of a nuanced argument to kind of to come out there and say, well, it's based on nothing, and there's no cash flow because gold had no cash flow, silver had no cash flow, virtually anything that isn't a corporation that you invest that you put your money in doesn't have cash flow. Um, a house, correct me if I'm wrong, but a house has no cash flow. A property has no cash flow once you unless it's an income generating property. But if you're like but you'll go but your primary residence where you live, you're not renting any rooms out. You're actually putting money in on your utilities. You're putting money in on your mortgage, and then even if you're paid off your mortgage and you only have utilities to pay and taxes to pay, you're not renting out. You're not making any money. So yeah, I mean that's my whole argument. Now, if I mean that's what I want to talk about on that. Um, where's it? 150. Now I came across this and I wanted to kind of talk about this. I came across this. I came across this, and I'm going on Reddit for a second, but I came across this. Here, I have the photo on my laptop. Let me try and find it. Okay. Okay, here we go. I found it. So, hope you can see my screen. Yeah, you can see it. So, I came across this, and basically, it's what's interesting about it is, let's see, this was created in 1875. It's speculation whether this is I mean, I've heard some people say maybe this is all BS and that, or maybe this is fake. But I came across this image on socials, and then I on LinkedIn, and then I'd come up, and then I googled it, and the whole Reddit page, and you read people talk about it. But what's crazy is this is spot on. Now, let's play innocent for a second. Let's say this is 100% a real thing that was created in um back in the back in 1875. 1927. So basically, A is the years when panics occurred. Let's bear in mind that the peaks are during the period of panic. So 1927, 3 years before the 19 or 27, 8, 9, so like 2, 3 years before the 1929 crash. By then, you had high inflation, panic was settling in. You had 1945. This is post-war Reconstruction. Um, People were panicking. People were in debt. Caused a global recession. Actually, the boom was when the U.S. in the 50s. The U.S. was basically acting as a lender of last resort for Reconstruction. That's actually this is fun fact. That's kind of where the gold standard kind of began. The Bretton Woods era began. 65, 81, the 81 crash. 99. That's when panic, and 2000 dot com crash. 2019, 2 months off, like a few months off, I think it happened. Let's assume end of year. This is end of year 2019, end of year. Even then, it's a year. Then it's a year and 2 months. But let's say I'm assuming it's end of year 2019 or 2019 mid 2019. That just makes it 7 months off because 2 months because February was when the crash really happened. Around February, mid February, I believe, and then 2035, 53 haven't really happened yet. Um, then years of good times, prices. So then I guess B. I guess kind of give you the rundown. A is when you should essentially, A is when you should is when the panic. B is when you basically, B, I believe I understand correctly. B is when you should buy. C is when sorry. B is when you should sell. C is when you should buy. A is the panic. So I guess A and B are the same. A and B, you should sell. C, you should buy. Um, Now, I don't know. We don't spend too much. I won't spend too much time on this, but I just want to share my thoughts. I think there's would be really interesting, and maybe I'll look into this. Is it seems almost geometric. I mean, there must be. I wonder if there's some sort of series that they're using that he used to predict this. And this guy was a farmer, like the Brenner guy that created this. He was a farmer, and he was likely looking at this from seasonal, when you deal with crops, for example, crops are cyclical. They have seasons. You might have two planting seasons for some crops, depending on where you are on latitude or on your longitude where you are. Um, but what's interesting about this is it looks like there is some sort of like there's some cyclicality happening here. Um, It'll be interesting to actually think about actually now that I'm off the top of my head, I'm just thinking about this. It'll be interesting to see if there's any correlation with I heard an expression from someone once said every 100 years ago we see this shift between global monetary. So like 100 years ago, every 100 years, 70 years ago or something, we had the Great British Pound. Now we have the U.S. dollar, and they're talking about de-dollarization now. So possibly in the next 30 years, you could be looking at a new global currency, um, and that is kind of interesting if you ask me. Like I think maybe it's some similar. There's some similar dynamic here. Um, Yeah. Let me know what your thoughts on this is. I'm skeptical. I much as I want this to be true, I'm kind of skeptical that I always like to play the skeptic, if I believe something, I believe it. But if there's not it, but if it's just taken at face value, I will be a bit skeptical. So let me know your thoughts in the comments. But yeah, anyways, hope you enjoy the live stream. If you guys haven't, you should sign up for my podcast. Sorry. Me. If you haven't yet, sign up for. Don't forget to subscribe, like the video, sign up for my newsletter, the weekly commodity pulse. I post twice a week on Mondays. We kind of do an op-ed thing where you'll see article. I usually post a couple articles about what's going on, give an op-ed analysis of what's going on in the markets, kind of like note, like as if I'm writing my notes. And then I also give for premium subscribers on Monday. You will also get supply chain analysis, sector sentiment analysis. Fridays, I'll usually take questions or give some bullets or analysis if there's no questions that week on something happening that's happened during the week. But if you're usually very brief to the point. Premium subscribers will also on Fridays get exclusive access. There's more coming soon. You're going to get exclusive access to CFTC analysis, top 31-day movers for commodities, equities possibly coming soon. Not 100% sure what I'm going to do with that, how I'm going to do that yet, or what format I want to do with that. But forecasts are coming too soon as well. But currently, we have CFTC analysis. We'll do we'll do technical analysis, fundamental analysis of these commodities. We'll usually look at some trends. What we also give a short-term outlook, what to expect what to expect in the coming week on these commodities that were selected as top movers in terms of return. And yeah, but anyways, let me know if you have any questions. The link to the newsletters in the bio. Yeah, and don't forget to like, subscribe to this video. We really appreciate it if to help me out in the algorithm.